What up, investors? Phan here, back again with another episode of Finance, where I keep you plugged into the markets. This week, we're going to talk about why the market got slapped in the face. Who to blame? China, Europe, and the job numbers. So let's do this. Okay, so what happened this past week? Let's take a look at the 5-day chart. Here's the S&P, Dow, and the NASDAQ. Clearly, the market did not have a good week. The sell-off kept getting worse as the week progressed. Yeah, I feel you, Kels, but no need to cry over a minor market dip. Let's dig into what drove the sell-off. It was a host of all this crappy macroeconomic data. The growth outlook in China is deteriorating, so is Europe's, and the US job numbers were surprisingly weak. Okay, so let's talk China. The Chinese government unveiled its growth outlook for the year this week, and it disappointed. This year, China GDP is expected to grow between 6 to 6.5%, a little bit shy of the 2018 target of 6.5%. And you can see that generally the long-term growth trend is moderating. On top of that, Chinese exports declined over 20% year over year in February, which means they're not selling as much stuff to the rest of the world, and that just adds another proof point that their economy is slowing down. Things don't look much better in Europe. This week, the ECB lowered its growth outlook for the region. The ECB stands for European Central Bank. It's like the European version of our Federal Reserve. In 2019, the ECB expects Europe's growth to slow down to 1.1%. Previously, they were targeting a growth rate of 1.7%. They also nudged down their numbers for 2020 as well. Why does it even matter if Europe and China's economy slow down? How does that impact the US stock market? Well, slower growth in Europe and China matter because a lot of US companies do business in those regions. If you take the S&P 500, for example, which consists of the 500 largest publicly traded companies in the US, we can see that China and Europe make up at least 10% of the revenues of all the companies included in the S&P. And more likely, that number falls somewhere between 10 to 20%. So it's meaningful. If China and Europe's economy weaken, they can't buy as much stuff from American companies, which in turn can hurt their stock prices and drag down the overall market. Shifting our attention to the US, the jobs number disappointed. The jobs report is a monthly report issued by the government that tracks the number of jobs created within the US. It usually comes out on the first Friday of every month. In February, the US economy added 20,000 new jobs, but economists were expecting 180,000. That's a pretty dramatic miss. So Europe and China are slowing, and US job growth seems shockingly low. What should you do? My advice? Be like Gayle. Look at this woman. She's a boss, cool as a cucumber in the midst of folks wilding out. While slowing global growth isn't ideal, we'll get through this. Both Europe and China are slowing, yes, but their GDP is still positive, and they both intend to juice their economies. Europe is going to keep their interest rates low for a while and encourage banks to lend to consumers and businesses, and China intends to cut taxes and boost lending to reignite growth. If a trade deal gets done with the US, which I still expect to happen, then the market should continue to march higher. As for the jobs number, 1 month doesn't make a trend. Plus, there could be a whole range of factors driving that shockingly low number. One is seasonal. For instance, if it's a really brutal winter, jobs and hiring in construction can really drop off dramatically because projects get put on hold. And the government shutdown could have played a role as well because the E-Verify system, the federal electronic service that verifies employment eligibility, wasn't up and running. So that could have delayed hiring. I think it makes more sense to look at the jobs number as an average over the past few months than looking at any one particular month in isolation. And if you look at the average over the past, say, 3 months, the job outlook still looks pretty healthy. So I think you don't need to fret too much about Europe, China, and the jobs number. Sit tight and stay invested. All right. Hope you found this week's episode helpful. If so, be sure to like the video. And if you want to stay plugged into the markets with me, hit that subscribe button. Until next week, stay up and invest wisely.
20 out of 20, please try not to cry on me. Now that all my dreams are manifesting, faces